Business Finance Unit 3, Income Statements 3.1 Income Statement Basics 3.2 Profit versus Cash 3.3 Importance of Income Statement. Income Statement Basics. One, accounts are the financial records of a firm's transaction. 2. Financial accounts give details about a business' financial health over a period of 1 year. Financial accounts include the statement of profit and loss and the statement of financial position of a business. 3. Accountant is a professionally qualified person who is allowed to prepare the financial accounts of a business by using accurate records of financial transactions of the business. Accounting records. Accounting records helps the business to know how many customers bought goods on credit and on cash. Accounting records helps the business to know when it bought materials from suppliers and if the purchases were made on cash or credit. Accounting records helps the business to keep track of all the taxes it paid to the government. Accounting records helps the business to all the expenses paid such as wages, utility bills, purchase of equipment. Profit versus cash. Profit is the difference between sales revenue and expenses incurred. Profit is classified into gross profit and net profit. Profit is a reward for the business, entrepreneurs and shareholders for their capital investment. Profit is a source of finance that is used to expand the business. Profit is an indicator of the success of the business. Cash is the most liquid asset that a business has to finance its daily operations, whereas profit is the remaining balance when all of the business's operating expenses are subtracted from its revenues. Cash is the money actually available in the business, whereas profit include both cash transactions and credit transactions. High profits does not mean high cash. Income Statement Basics. Trading account shows how gross profit or loss has been made from the trading activities of the business. Trading account records the sales revenue, the cost of goods sold, and the gross profit. Sales revenue is the total value of sales made during the trading period. It is composed of both sales made on cash or on credit. Cost of goods sold is the direct cost incurred while making sales in a financial year. It includes cost of purchasing raw materials, cost of producing finished goods, and costs incurred in selling the finished goods such as transport, delivery of the good to the customer. It is also known as cost of sales. Gross profit is the difference between sales revenue and cost of sales. An income statement is a financial record of the revenue of a business and all expenses incurred to earn that revenue over a period of time. It is also known as profit and loss account. Depreciation is the fall in value in a fixed asset over time. It can be calculated using the straight line method or the reducing balance method. Net profit is the remaining balance available after all expenses, direct or indirect, have been deducted from the sales revenue. Retained profit is the balance available after corporate tax has been deducted and dividend paid to shareholders. Retained profit is the sum available that is reinvested into the business. So, income statement always start with sales revenue. Then, we calculate the cost of goods sold by adding opening inventory with purchases and minus closing inventory. To get the value of gross profit, we minus the cost of goods sold from the sales revenue. To find the net profit, we subtract all the indirect or operating expenses such as advertising, insurance, rent, wages and salaries, depreciation, interest paid. We then subtract the corporate tax and dividend paid so as to obtain the retained profit figure. You must note that trading account refers to all transactions occurred that relate directly to sales, while profit and loss account refers to transactions that do not directly relate to sales. Importance of an income statement. Guide managers to know if the business is making a profit or a loss. Guide managers to compare business performance with competitors' performance by comparing gross profit, net profit, and retained profit. Guide managers to calculate profitability ratios, gross profit margin and net profit margin, and those ratios can be used to compare business performance with previous years or with competitors. Guide managers to understand how the expenses incurred in the business have helped in generating sales revenue.